Good evening, everyone. My name is Jason Frank. I'm the Deputy President for Nottingham Investment Services. It's my pleasure to welcome you this evening for what will be an informative session on all things related to trusts and choosing the right trustee. I'm hoping that this evening you'll learn what a trust is and how it works, the key roles of grantors, trustees, and beneficiaries, how trusts can save time, provide privacy, and protect your assets, the pros and cons of individual versus corporate trustees and how to choose the right one for your needs, and common myths about trusts and why they're often wrong. I'm thrilled to introduce my colleague and featured speaker for this evening, Brett Zelasco. Brett leads our Nottingham Trust Division. Brett's going to share a bit about himself and then lead this evening's discussion. We'll conclude following Brett's remarks with a Q&A session between he and I, just covering some of the most common questions that he and his team receive. Brett, with that said, thanks so much for joining us this evening, and I'll hand off to you.
Excellent. Thank you, Jason. Glad to get the technical difficulties out of the way right out of the gates there for us. Good evening, everyone. Very happy to be here with you tonight. Very much appreciate all you taking the time after a long, rainy Wednesday, at least here in upstate New York, to join us and learn a little about trusts and how they can help people from all walks of life accomplish their financial goals. So as Jason mentioned, my name is Brett Zelasco. I'm the Senior Vice President and Head of Community Bank's Nottingham Trust Division. Graduate of SUNY Oswego, and then I went on to Western New England College Law School, actually Western New England University now. They've upgraded since I left, obviously putting my tuition to good work there. And I've been working in the bank trust industry for over 15 years now, based in central New York, but our Nottingham Trust division spreads across New York, Pennsylvania, Vermont, over 3,000 clients and just over $4 billion in assets under administration now, providing a variety of trust services here in Nottingham, but our bread and butter is trust administration. So that's what I'd like to spend some time discussing today. So just as a real quick general disclaimer, I'd say today's presentation is an introduction to trusts. If this were college, it'd be like a 100-level prerequisite course. It's really a general overview of trusts, what they are, how they work, and what benefits they provide. And also discuss some of the benefits of naming a corporate trustee like Nottingham Trust to administer your trust rather than an individual friend or family member. The information today really just meant to get your mental gears a-turning, to get you thinking about trusts and how they could have a place in your financial and estate plan. But what I will not be doing today is answering probably questions specifically for your situation. Is a trust right for me? That we can't answer without a more detailed conversation with you about your needs and goals. But if anything you hear today is intriguing, if you want to discuss it further, how it could work for your situation, then I certainly urge you to reach out to your NISI financial advisor if you're fortunate enough to be working with one, or if not, feel free to contact our Nottingham Trust team and we can take a deeper dive on your specific situation. So without further ado, we'll jump into the world of trusts. And, what is a trust? That seems like a pretty good place to start, right? Well, at the simplest level, a trust is just one of several methods you can use to transfer assets to family, friends, and charities, either at your death or during your lifetime. There are other methods of transferring assets. You can gift assets away during your lifetime. You can create a will and distribute your assets through the probate process. You could also do nothing at all and pass away without a will and let your state's intestacy laws, as they're called, control where your assets go. But spoiler alert, that is the worst plan available. By no means should you ever do nothing and let your state of residence decide where your assets are going. That's pretty obvious. But beyond transferring assets, trust can be a useful tool in preserving or protecting your assets from creditors, from debtors, from long-term care facilities, or in certain cases to minimize income or estate taxes. But before we can start discussing different types of trusts and their pros and cons, I think it's best to first define some of the basic terms and the people involved in every trust. Every trust starts with a grantor. So this is the person, could be you, who creates and establishes the trust. It's also typically the person who funds the trust or puts assets into that trust. Although in some cases, once a trust is up and running and created, it can be sort of like an open receptacle into which other friends and family members can actually contribute assets. But the grantors are the people who initially create that trust. And how do they do it? Well, they draft a trust document. or more likely they work with a qualified estate planning attorney to have a trust document created on their behalf. Probably the most critical step in the process, because the trust document that you create is essentially the rule book for the trust. That's the document that defines who gets the trust assets, who gets the money, and under what circumstances. It defines which beneficiaries will receive those assets if the ones you initially named are no longer alive or available, how long the trust lasts, and countless other administrative sort of guidelines. Now, if the trust document is the rule book, then the trustee could probably be considered as the referee or the umpire. The trustee is critical to the success of the trust. This is the person or entity, like a bank trust department, that the grantor chooses to administer or carry out and run the trust. That basically means the trustee is responsible for enforcing whatever rules the grantor established for the trust in their trust document. In some cases, there's just one trustee. In other cases, there's multiple co-trustees working together. But no matter what, the fact remains that every trust is really only as good as the trustee who administers it. So you can spend weeks and months working with, the best attorneys in the country to create the greatest, one trust document to rule them all. But if you name someone to be trustee who's inexperienced or incapable of making difficult financial decisions, then it's all for naught. So choosing the right trustee is really just as important as creating a solid and quality trust document. But a trust document is really nothing more than just an expensive piece of paper if you don't fund the trust or deposit assets into the trust. Trust assets, really anything of value that is owned by the trust. It can be cash, it can be investments, life insurance, real estate, and so on. And the people or entities that can receive benefits from those assets are what we refer to as beneficiaries. There could be only one beneficiary. There can be several beneficiaries. There can be a group of beneficiaries for a period of time that switches to another. It's totally customizable. They can be people, they can be charities. But even though, the term assets and beneficiaries are pretty straightforward, I wanted to specifically define them because this is a very common mistake that we see many people make. They spend time and money to create a trust, and they leave their attorney's office with a big smile, the sunshine, and they feel good that they've finally taken the steps to set up a trust and estate plan that they've probably been putting off for years. But then they stop there and they think the job is done, and they never actually fund the trust. So if real estate's supposed to be part of that trust, they might forget to take the next step and have that property retitled into the trust's name. That's how you fund that asset into the trust. If cash or stocks or bonds are supposed to be part of the trust, they might never have their bank checking account or investment accounts retitled into the name of the trust. That's how you fund those assets into the trust. Now, typically, a good estate planning attorney will give you instructions, sort of step by step. This is what you need to do to fund your trust. And the really good ones will follow up and make sure you do that. But just, for this group, remember, if you don't take the steps needed to actually retitle accounts and assets and fund your trust, then there's nothing in that trust that can be distributed, nothing for the beneficiaries, and the whole plan, despite your best intention, fails. So certainly critical to do so. Just a few more common terms to define before we move on. Another thing the grantor defines in the trust document is the trust term, or in other words, that's how long the trust is going to last. In some cases, that might be a specific defined number of years. In other cases, it depends, on certain beneficiaries' lifetimes, and when they pass, the trust may terminate. So there's sort of an uncertain period of time. But inevitably, there's typically an end or a termination to the trust. Before that happens, before the trust terminates, while the trust is up and running, there are usually two different buckets of assets within the trust. The first is what we refer to as trust principal. And you can really think of that as the assets or cash or stocks or whatever assets you deposit or fund into the trust. That becomes the trust principal. Once those principal assets are invested, they start to generate trust income, interest, dividends, the sort of new cash that flows into the trust because of those investments are considered trust income. Very similar to a loan arrangement in a sense. The chunk of money you borrow is the principal, and then there's an interest component to that that's comparable to trust income. Only in that case, you're putting money in, trust is kicking money out. That's an important distinction between principal and income because a lot of trusts are created with rules that only allow certain beneficiaries to only receive income with the dividends and interest generated by the principal. And then there might be other beneficiaries who are only entitled to receive trust principal. So knowing which beneficiaries are entitled to what and that they receive the correct, assets is a key role of the trustee. Now, once the trust runs its course, we get to the end of the trust term. The trust is supposed to terminate. Whatever assets are left and remaining at that time is what we refer to as the remainder interest. So a well-drafted trust document will define what beneficiaries are entitled to that remainder interest. As we mentioned, there could be people set to receive that, maybe grandchildren or great-grandchildren down the road will get lump sum distributions. Maybe it's a charity of some kind that you care about that, after your family and friends receive the benefits, you want that charity to receive the remainder interest. All of that is completely within the grantor's control and is defined in the trust document. Now, the last two terms here really serve to define the type of trust that is being created. Living versus testamentary is very simple. If you create a trust that is established and funded during the grantor's lifetime, then that's a living trust. If you create a trust within your will, your last will and testament, that doesn't get created and funded until after you die, then that's referred to as a testamentary trust. So there's no significant implications we're going to get into today in that regard, other than just defining when the trust is created. The last term, also relatively simple, but it has huge implications in regards to what type of trust you create and what goals you want to achieve. So the idea of a revocable trust versus an irrevocable trust. At the end of the day, those terms probably mean exactly what you think they mean. A revocable trust, it can be changed, it can be modified, it can even be canceled or revoked by the grantor who creates it, as compared to an irrevocable trust, which cannot be revoked. In some cases, the grantor may carve out little rights they have to change certain minor trust terms, maybe update the beneficiaries or other restricted changes they can make. But for the most part, an irrevocable trust is set in stone once it's created. And as I sit here and define those terms, you might be thinking to yourself, well, why on earth would I ever create an irrevocable trust? One thing we're all very much aware of is life changes. People change, circumstances change, people die, people are born, people get divorced, people get married. Why would I create an irrevocable trust? I'd be better off with a revocable trust that I can freely change as needed. But there are certain specific goals that you can only accomplish through the use of an irrevocable trust. And as rigid and unappealing as that may seem up front, when used properly, irrevocable trust can be incredibly beneficial in certain situations, which we'll discuss a bit more soon here. So that concludes our trust term definition section. Hopefully you're all still with me out there, but I do think it's important to define some of the terminology before we just start throwing terms around and assuming folks know what I'm saying. So quick recap. Every trust begins with a grantor. They create a trust document with an attorney likely, and that trust document or agreement provides the grantor's instructions on how the trust should operate. It also names the trustee or co-trustees that'll be responsible for following the grantor's instructions. So now we all hopefully have at least a basic understanding of what trusts are and how they're created. So for the $1 million question, why? Why does any grantor choose to create a trust? Well, obviously there's many different reasons for that, but some of the common reasons that we see include probably first and foremost avoiding probate. Now I have to say in many of the counties and areas where we all reside, particularly in the greater upstate New York area where I've personally been involved, the probate courts and processes aren't nearly as complicated or drawn out as people expect. I think in general, people have been convinced that the probate process is awful and you should avoid it at all costs. But in my experience and opinion, I think the probate process has received a bit of a bad rap, but it is a county-driven process, and some counties are better than others. And no matter what county you are in, there are downsides to the probate process. It does involve extra formalities and court involvement, which can scare off some people. There are some extra costs in regards to those court filing, fees and the like, nothing too significant, but certainly extra costs. And there's certainly a delay in how soon your assets can flow through probate and be distributed to your beneficiaries. That process typically requires that your assets sit in your estate for up to 6 months before they can be distributed to your estate beneficiaries, which can be a long time for individuals needing and expecting those funds. So trust can be a solution to that. With the right type of trust, you can completely avoid the probate process and have your trust assets set up to be available and distributed to your beneficiaries within days after you pass, rather than months. So I know we're listing this bullet point a bit further down our list here, but privacy, while we're talking about probate, is another huge benefit to trusts versus wills. Probate proceedings are public record. That means anybody who has a will and goes through probate, anybody can look up information on that person, on that estate, on that will, the size of it, who you're giving money to, and so on. Trusts, on the other hand, are private. Nobody other than the parties involved, the trustees, the beneficiaries, are aware of the trust terms, the assets, and the distribution scheme. Probably the number one most common reason we see as to why people create trust is the idea that it allows the grantor to control their assets beyond the grave. Now, I consider myself to be relatively responsible, level-headed person as I sit here at the age of 39. But thinking back to 18-year-old Brett at SUNY Oswego, if I had a parent or grandparent pass away during that time and either gift to me or leave me with a sizable chunk of money through their will, 10,000, 30,000, 100,000, 500,000, whatever that amount is, I would have received all of that cash in hand, no strings attached, for me to spend however 18-year-old Brett saw fit. I can honestly say I'm not sure how that would have worked out. And as much as I'd like to think I would have spent it responsibly and invested and saved, my priorities and interests were a bit different back then. And at least a portion of that money could have very well been squandered in ways that my parents or grandparents, didn't foresee when they made that, distribution. So trust can help solve for that concern. And that's a concern that many people have. The vast majority of time we're working with parents or grandparents who are creating trusts, and their goal is to fund that trust with assets, and they want their beneficiaries to receive them, but they don't want it distributed with no strings attached. They want some control over that, similar to how they dole it out during their lifetime. They want to limit the availability of those assets, and particularly if their beneficiary is young, going through college, those assets might only be available for their education expenses or their health related expenses, and so on, however you want to set it up. And they don't want those assets used for spring break trips and extra fun weekends. So that lets you sort of control and gatekeep those assets beyond your presence here on earth. Also, trust can be great for second marriages, particularly when you have kids from prior marriages that you're bringing with you to the new marriage, and vice versa with your second spouse. If I'm a grantor and I'm in a second marriage and I have children from my prior marriage, I may want my second and current wife to benefit from my trust assets while she's alive. But if I were to gift or distribute those assets to her outright, then those are her assets now. And once she dies, she may intentionally or unintentionally distribute those assets to her kids from her prior marriage, sort of leaving my kids out in the cold. And the trust can solve for that. And by defining, the current surviving spouse as a beneficiary only during their lifetime, and then you can distribute that remainder interest, as we talked about, once they pass away, either to my kids or our kids collectively, however, I see fit. So it helps solve for that problem. Another common concern we deal with is a desire to protect assets that you're giving to your children or grandchildren from that child's own potential divorce or separation. We work with a lot of grantors that say, I have a lovely daughter. She's married to this great guy. We just adore our son-in-law. But the reality is marriage dynamics can change, and that can happen after your death. So, in that, if that client gifted or distributed assets to their daughter outright through their will, then those assets could be commingled with other marital assets. And through a future divorce, the ex-spouse could walk away with a large chunk of that money that maybe the grantor only wanted to go to their daughter, or at the very least to their daughter and her husband while they were married. So creating a trust and funding that with the assets you want available to your daughter, but only distributed in certain circumstances, can protect those assets from any potential future divorce or separation proceedings, no matter how unlikely those may be. Another very common reason we see, it's typically on the forefront of a lot of our clients' minds, are asset protection purposes. You might want to preserve your assets from a nursing home or long-term care expenses, or maybe you want to distribute assets to your children, but you don't want those assets to be vulnerable to that child's debtors or creditors if they have financial issues. Trust can be a solution here as well. One key note I'll make in that regard, though, I mentioned earlier this distinction between revocable and irrevocable trusts. And the question we asked ourselves at that time was, well, why would I create an irrevocable trust? Revocable trusts seem so much more flexible. Well, although irrevocable trusts are certainly less flexible, they are the only type of trust that will achieve asset protection goals. So if you want to protect your trust assets from creditors or from long-term care, you need to set up an irrevocable trust. That's a key feature of asset protection trust that many people don't realize. In order to protect those assets from outside creditors, you need to cut off your own access to those assets. And that makes sense if you think about it, right? If I make a revocable trust and I have the right to revoke and cancel that anytime I want and take the assets back out and use them however I want, then if I go into a nursing home and they want to know what assets I have available to me, that would include the revocable trust and everything in it, right? If I have access and I tie a string to it that lets me get back to those assets and take them out, then the nursing homes and creditors and debtors have that same access. Moral of the story, if you have access, they have access. So that's why an irrevocable trust is key in those cases. Creditors can't get to the money if you can't access it yourself. It's sort of locked up in this protected irrevocable trust box. With the rising costs of long-term care, many of our conversations with clients in this regard center around nursing home, protecting assets from spend downs. But all this sort of serves to illustrate something very important, and it kind of seems to be an unfortunate surprise or realization to many clients that are looking to solve this problem. And that is if you create a trust to protect your assets from long-term care or creditors, you're not protecting those assets for you. Yeah, as we just discussed, for those strategies to work, you're cutting off your own access, meaning you can no longer use them for your own life expenses. So these types of trusts, I think it's key to know they don't protect assets for you. They're really designed to protect your assets for your beneficiaries, for your children and grandchildren and the beneficiaries you want to receive them. So there's something left for them to inherit after your lifetime. So I think that's a key aspect of those types of trusts that a lot of people don't understand sometimes until it's too late. And finally, trust can be a great solution in situations where you want to transfer some of your assets to a beneficiary who has a disability or receives public benefits. And you don't want them to receive those funds outright because that could disqualify them from receiving those benefits if you suddenly give them a pile of cash. Or there are other cases, typically with higher net worth individuals, that might actually be subject to estate taxes, and trust can help them structure their estate in ways to minimize those taxes, although both of those scenarios are a bit less common. So we've covered a trust and what it is and the major reasons why they're created. But that leads us to the other critical decision that any grantor has to make, and that is, who are we going to name as trustee? Well, at a basic level, you have two different categories of trustees. You have individual trustees and you have corporate trustees. Individual trustees would include any person. Oftentimes it's a friend or family member who gets tasked with the trustee role. Sometimes kicking and screaming, but that ends up being their job. Corporate trustees or professional trustees, on the other hand, would include trust companies or bank trust departments like Nottingham Trust, who are named as trustee, or in some cases, maybe successor trustee that will take over, as trustee down the road once an individual trustee dies. Now, to be clear, the roles and responsibilities of that trustee do not change, whether it's an individual or corporate trustee. The job is the same either way. And unlike administering an estate through probate, which is typically resolved and finalized within 6 to 12 months after the grantor dies, the assets are distributed, you wash your hands and walk away, a trust could carry on for generations. So the trustee is potentially signing on for that gig for the long haul. Now, in our experience, I think grantors will consider naming friends and family members as trustee because they want someone they feel they can trust, no pun intended, someone who knows the beneficiaries, And a lot of times they want someone who will do it for free or not, charge a reduced trustee fee. Although even individual trustees are fully entitled to collect the same fees that a corporate trustee can, and they often do. And there are some circumstances where appointing an individual trustee works fine. Maybe the trust is small, distribution's really straightforward. Maybe your family member is an experienced estate attorney or trust tax accountant or somebody that has knowledge and experience with trust and fiduciary laws. But I would say those situations are somewhat rare. And in many cases, the problems with naming an individual trustee can be significant and long lasting. Just for consideration, here some benefits of a corporate trustee versus an individual trustee. First of all, obviously, there's the experience and expertise that professional trustees can bring to the table. As an organization, speaking at least for Nottingham Trust, we've collectively seen it all. We've seen all types of trusts, all types of assets, all types of investment markets, all types of beneficiaries. And over our 100+ years administering trusts, we've built this sort of Rolodex of experiences that we can use and rely on to efficiently and effectively administer new trusts that come our way. Individuals don't have that sort of breadth and experience, so when they encounter unique or difficult administrative issues or questions, they might very well make the wrong decision that could compound into larger issues, or maybe they have to reach out to an attorney. I mean, best case scenario, they reach out to an attorney or legal advisors to get some actual conclusive answers on what they should do. But guess what? That legal advice isn't free. So that individual trustee you chose in an effort to avoid trustee fees, they're incurring legal fees that are charged to the trust in order to do that job. Whereas a corporate trustee would already know how to navigate that situation. Or, oftentimes there's a complicated tax question. A lot of trusts have their own tax ID, file their own tax returns. The decisions a trustee makes can have huge implications on potential taxes for the trust and the beneficiaries. So that could lead to unexpected tax bills, or perhaps they need to consult with an accountant to get the guidance they need, and which a corporate trustee would already possess. And guess what? That CPA is going to charge the trust for those services as well. So potential for unexpected costs when naming individual and somewhat unexperienced trustees. Beyond experience and expertise, a corporate trustee's life cycle can be much more appealing than an individual trustee. As a bank trust department, we don't die. There may be mergers and acquisitions, but the corporate trustee role survives those sorts of events and carries on. And so you may have the perfect individual trustee in mind, but one thing I can tell you for certain is someday that perfect individual trustee is going to die, and then who is going to step in? So as the next trustee is experienced and capable, and availability is a huge issue here as well. If you have an individual trustee, what if they're on vacation in the Bahamas when a trust beneficiary needs a distribution, or there's an administrative task that needs to be completed, time sensitive? What if they're sick and in the hospital? Is that person going to set aside their vacation or, fill their trustee role from a hospital bed? Maybe not. But that's not an issue with corporate trustees. Even if the main trust officer relationship manager you work with is out of the office or leaves the organization even, there are other contacts. There's a full stable of trust officers and personnel in that group that can step in and seamlessly administer the trust in those cases. Probably the biggest advantage that we've seen over corporate trustees present over individuals is impartiality when dealing with beneficiaries and distribution. This is a big one. Many times grantors want to appoint family or friends as trustees because they know the beneficiaries, they have existing relationships with them. I'm here to tell you that's not always a good thing. And in many cases, it can be a bad thing. Many trusts have multiple beneficiaries, which means you have more than one person's interest in the balance with every decision you make. We've seen this scenario play out many times, but consider a grandparent. A wealthy grandparent creates a $500,000 trust for his two grandchildren. We'll call them Jessica and Jeffrey. The trust is only to be used the way the grantor sets it up for their health and education, at least until they both turn 25 years old. And at that point, it terminates, and whatever's left in the trust, that remainder interest, is split evenly between the two kids, Jessica and Jeffrey. Grantor decides to name his brother as trustee. What could go wrong? It's all in the family. If the kids need something, they can just go to great Uncle Larry with their request. So let's say Jeffrey, 20 years old, 18, 19 years old, and he's going to a local community college. He'll come to Uncle Larry, present a $10,000 tuition bill. Fine, no problem. Trust is here for education. Now here comes Jessica. She's going to Syracuse and her tuition is 65,000. Can it be paid from the trust? Sure, it's for education. But, that gets Jeffrey thinking that this is a bit unfair. I take 10,000, she takes 65,000, and this is going to happen for, 3 more years. When the time comes for the trust to terminate and the assets are split equally at that point, hasn't my sister Jessica made out with so much more money from this trust because her expenses are greater? But, maybe Jeffrey's a sly fox. He sees where this is all going, so he comes to Uncle Larry, hat in hand, to plead his case. Uncle Larry, I'm commuting to college my first 2 years. I really need a vehicle to get myself to school and back. The trust is for education after all. Isn't a new car necessary for my education? That's a pretty compelling argument. But what if Jeff is asking for a brand new Mercedes-Benz S-Class for his vehicle? Come on, Uncle Larry, Jessica's taking 6 times what I'm taking out of the trust for tuition. Isn't it fair that I get a car like this that's commuting to school, try to make up some of that gap? Now, put yourself in Uncle Larry's shoes, right? That's a rock and a hard place. Either you say no to Jeff, you're getting a Honda, and you potentially, ruin your relationship with your nephew, at least from his perspective. Or you say, yeah, you make a good point, Jeff. And now Jessica's breathing down your neck for distributing $115,000 for the trust for a car. Tons of lose-lose scenarios out there for individual trustees. I know that may seem a bit dramatic, but I can assure you that over the course of a trust, with the lifetime of a trust with multiple beneficiaries and interests involved, there are countless decisions along those lines to be made. And you ask yourself, do you really want a family member or friend to be in that role, making those decisions and facing the consequences with the beneficiaries? Or would you rather have a neutral, the big bad trust department in that role? And we'd be there administering the trust objectively, nothing guiding us other than the trust terms and the grantor's original goals and intentions. But we always tell people, a corporate trustee like Nottingham Trust, we can save your family Thanksgiving dinners. It may sound like a bit of hyperbole, but these responsibilities and challenges can truly impact your family dynamic when you have those individuals involved in that role. And a lot of times it's in a negative way. Finally, I'll just mention the compliance and operational benefits to naming a corporate trustee. For one, in most states, trustees are required to fully report all trust activities to the beneficiaries, to give them statements of what's happening in the trust, where's the money going, how much is being distributed, how much are the investments making. As a bank trust department, we have a never-ending carousel of auditors and regulators monitoring what we're doing and making sure we're fulfilling our role, that we're distributing statements, that we're being transparent. When individual trustees are involved, there's oftentimes a lack of transparency and reporting to the trust beneficiaries. In our example above, let's say neither beneficiary ever got a statement or report from Uncle Larry. Jessica might have no idea that Uncle Larry just involved or allowed trust money to be used for Jeffrey to purchase a new Mercedes, at least until the trust terminates and she sees all the damage from that. How would she react? Feeling like that information had been hidden from her perspective for years? Probably not too good. And last but not least, as corporate trustee, we are bonded and insured. So if there's an issue, some sort of problem that requires a trustee to pay damages or refund certain monies to a trust, a corporate trustee can do that. We have deep pockets, as they say. Individual trustees, likely not. The old blood from a stone cliche, right? So no shortage of reasons as to why corporate trustees can be a better fit in these cases. This slide here really just summarizes those main reasons we discussed. Corporate trustees provide an advantage when it comes to expertise, availability, and longevity. Impartiality, that's probably the biggest one, and then legal responsibility and compliance. Now, that's a ton of information I've just laid out there in a relatively short period of time. It's a lot to digest, and I certainly hope it piques some curiosity and questions from you in regards to trust and whether they're a good solution for you and your family. What I'd like to leave you with before we wrap up today are a few common myths that we run into time and time again that really don't hold up today if they ever did. Number one, the idea that trusts are only for the wealthy. Now, back in the days of the Vanderbilts and the Rockefellers, this was probably true. Only the wealthiest families used trusts, and they used them to preserve their assets within their families for multiple generations. As we sit here today, though, this statement is now completely false. There are higher net worth individuals who may have more reasons to create a trust. There may be tax benefits or business succession benefits, real estate management, all the problems the high net worth individuals have. But the reality is that trust can be useful and appropriate for many families across the financial spectrum. We mentioned supplemental needs trusts earlier, or trusts that are created for family members with disabilities. That's a need that does not discriminate or apply to just wealthy families or just families with less wealth. Protecting assets from long-term care, that's a pretty universal need, regardless of your net worth. So the days of trust only being useful for the ultra wealthy, I would say are long gone. Number two, there's a concern, if I create a trust, then I'm going to lose control of my money. Well, that can be true in some cases, but overall, as a general statement, I'd say this is false. You're the grantor. You create the rules in the trust document. If you don't want to lose control of your assets and create an airtight, irrevocable trust, you don't have to. Now, maybe you do need to limit or cut off your control in certain situations and for certain assets, as we discussed, to accomplish, asset protection goals, for example. But that's still entirely in your control as grantor, and by no means is that like a default result when you create a trust. Finally, number three, I don't need a trust. I already have a will. We hear that quite a bit. And in some cases, with small estates involved, very few beneficiaries, that's entirely true. But as a general statement, it's entirely false. If gifting your assets or distributing them all to beneficiaries through your will is right for you, then, fantastic, go for it. But for all the reasons we discussed and many more we didn't touch on today, even with an established will, trust can provide solutions and benefits that you can't get through other methods of transferring assets. So in summary, as challenging as it is to sum up our entire discussion here today, the bottom line is trusts are the most flexible and customizable method available for transferring your assets, either while you're alive or after your death. Maybe you have complex family dynamics involved. Maybe you have charitable goals. Maybe you have asset protection needs. Trust can be the solution to all those problems and more. So with that in mind, as I've said already today, if any of your discussion or our discussion today has got you thinking about your own estate plans, your own assets and beneficiaries, and how you can best set those beneficiaries up for success after you pass away, then I would certainly urge you to reach out to your NISI financial advisor, if you're already working with one, to discuss your needs and how Nottingham Trust could potentially help you in a corporate trustee role to achieve those goals. Or if you don't already work with any of our advisors or trust officers, please feel free to reach out to our teams. We'd certainly be happy to further evaluate your own situation and customize the solutions that'll work for you and your family. So last but certainly not least, thank you all very much for your time and attention tonight. I truly hope you derive some sort of benefit from the discussion here, or learn something new that'll help you better prepare your estate plan to meet your needs. And with that, I'll toss the microphone back to Jason for some follow-up thoughts.
Yeah, Brett, that was fantastic. I'm reminded whenever we connect, or I hear you present, or I connect with a colleague from Trust. I mean, this was as you described it, the intro version of this, and it's complicated, and it's why we've got expertise to support all of you to navigate this world. So as much as I'd love to pepper you with a few questions about Uncle Larry, Jessica, and Jeffrey, and what their Thanksgiving dinner table conversations look like, a couple of things that come to mind, and I know things that are common that you and your team see. What types of assets, can be placed into a trust, or, what are you commonly seeing as assets that are placed into trust? Maybe talk about that a bit, because assets is obviously a broad categorization, and I just want to make sure folks get a chance to get a flavor for, what are you typically seeing?
Yeah, so I guess the short answer is really anything of value could be an asset that can be held in the trust. I think the trick a lot of times is funding it into the trust. I mentioned that's a step people miss oftentimes. But it's really as simple as, retitling an account into the name of your trust, or re-registering or retitling your property into the name of the trust. The assets we typically see, yeah, it depends on, a lot of times, the type of individual we're working with, obviously. Typically, it's cash, stocks, bonds, typical securities. Real estate can fund trusts. As if you're a business owner, you could have small, business interests owned within a trust, which can help with some succession planning. There's really no limit. As we get into the modern era, we're starting to see, intellectual property and trust sometimes, and cryptocurrency and those sorts of things. All these assets do bring their own wrinkles to the table, and ultimately that's another area that corporate trustees can bring value as opposed to an individual trustee. We have experience. Real estate in a trust is a totally separate beast. You're, as trustee, responsible for that real estate. You need to make sure taxes are paid and it's insured, and it's not crumbling, that it's being appraised and managed correctly. If it's an income property, there's even more that goes into that. So I think the value of a corporate trustee really starts to stand out when you start to get more involved in complicated assets into a trust beyond cash and, stocks and bonds like you typically see.
So super helpful. Maybe a follow on to that, how do you actually transfer an asset or a fund? How do you fund the trust? How do you actually get the asset into the trust? Is that part of, what obviously the trustee can help with deciding what may go in there and be consultative, but how do you actually put those assets into the trust?
Yeah, well, it's as simple as, I guess the answer really depends on what type of asset you're working with, but in most cases, it's as simple as just retitling an account. So if I have a checking account with $20,000 in it, it's in my name. That's my asset. If I die, that will flow through my estate, so it'll go through probate. I'll have to have a will for that. If I wanted that $20,000 to be a part of my trust and part of that distribution scheme, I'd simply go to the bank and have them retitle that account into the Brett Salasco Irrevocable Trust, or whatever the name of my trust is. Obviously, you'd need the trust agreement for that, some identification, whatever else you need to actually open an account. But it's really that simple. And yes, there is quite a bit of planning that should go into deciding what assets can fund a trust. In some trusts, an asset that's highly appreciated, that you invested a little bit of money in and it's just grown substantially, that might not be a good asset to put in certain trusts, because if you own it or it's in another type of trust, when you die, you get that step up in cost basis. All those unrealized gains can go away. And in other cases, that's the perfect asset to put in a trust. If it's a charitable trust you're creating, you can park that highly appreciated asset in this charitable trust. You can actually sell it, and all those capital gains are ignored by the IRS, because it's essentially a charitable trust and there's a charitable beneficiary involved. So that can be a great way to meet your charitable goals, while getting rid of, so to speak, problem assets which have just grown so much and you don't know what to do with, because you don't want to sell it and realize gain. So the type of trust and the type of assets are very much a case by case and analysis, and there are definitely certain assets that are more appropriate in certain types of trusts, and that's what a qualified attorney and trust company can help you navigate.
So maybe last question before we let you off the hot seat. You just talked about taxes. So everybody's favorite topic. Who was responsible for, filing the taxes and the tax returns and that process, right? You mentioned that along the way, but who does that ultimately fall to?
Well, as you can imagine, the answer is it depends. Most trust, when you create, a lot of times you create a revocable living trust, which is what we alluded to earlier. That's kind of a trust that isn't even there, right? I mean, you can revoke it. A lot of times the person who creates it names themselves trustee, so they're moving money in and out. They're paying their bills just like they always had, like there's no trust there. A lot of times in those cases, the grantor's tax ID is still attached to that trust. So if those trust assets are making dividends, interest, those tax liabilities are flowing directly through to the grantor, and he's reporting that on his own tax return, just like he would if it was his own account in his own name. Then there are other trusts that require an actual, tax ID number of its own, and it files its own tax return. It's like a totally separate entity. In those cases, the trustee is responsible for completing, filing that tax return. And that's where, in those cases, the trust in some cases may be responsible for the taxes that are accrued over the course of a year. So if the trust assets earn dividends and interest, maybe there's assets sold in there that create and trigger capital gains. Those might be trust or taxed to the trust. Those could also be taxed out to the beneficiaries if they take some distributions. And in a lot of cases, the beneficiaries, their initial response is, well, I don't want those tax liabilities to pass out to me. I don't want to pay taxes on it. But that's actually beneficial in a lot of cases because trusts, the tax rates for a trust are compressed so much compared to individuals, that you're hitting the highest tax brackets with 10, 11, 12, $13,000 in income in a trust, whereas it's hundreds of thousands of dollars for an individual. So, or, joint filer. So, the process of filing those returns, making the decisions that aren't going to cause too much taxes in the trust and deciding, should we keep those in the trust? Should we pass them out to the beneficiaries? It's a huge part of the trustee's job. And a lot of times, individual trustees don't realize that until they're getting those tax bills and it's too late and the moves have been made. So it's, another reason that the corporate trustees can bring some value to that situation.
Well, listen, Brett, this was fantastic. I appreciate you. I can't thank you enough for the time and the presentation.
My pleasure.
For there, couldn't be more grateful that you spent some time with us this evening. I absolutely hope this added value for you. And as Brett mentioned, if you have any questions at all, and you're already working with a financial consultant, please reach out to them directly. If not, please reach out to our teams, from all of us here at Nottingham and community. We thank you for your business. We look forward to working with you, and we hope that this added value for you. We will be hosting another webinar in Q4. Topic will be forthcoming. Once we have that settled, we'll get that information out to you and be on the lookout for that invite. So, Brett, thanks again, and thanks to everyone on the line. Have a great evening.
Thank you.